welcome everyone. My name is Matthew Ike. I am the Executive Vice President of U.S. Energy Development Corporation. I also sit on our board of directors and the CEO of Westmoreland Capital, our broker-dealer. So the purpose of today's call is to give a hopefully concise overview of the status of the oil and gas markets and really where capital formation is trending at this point in time. So with that, let me start the conversation by talking to you a little bit about where we've been here in the recent past. So as many of you have known, specifically with the oil markets, prices have come down precipitously from their peak. Depending on how you want to slice this up, you could say from peak to trough, oil was from 147 all the way down to the high 20s. You could elongate that and say the market is still about 29 to 30% below where it was when oil was trading above 100. Or you could take the other lens in perspective, and you could say from its trough, oil is now up 146%. So everything is all relative to what point in time one would want to dissect the actual pricing of the commodity. But ultimately, I think it's much easier to say that, statistics aside, we went through a period where oil prices climbed pretty rapidly and then very quickly took one heck of a hit and have remained much lower, much longer than many analysts on Wall Street had prognosticated. And I think the overlying effect is where is the status and the health of the oil and gas industry? And I think it kind of separates into a bunch of different pieces depending on where you are in the value chain. So if you're on the debt side of the value chain and you're the first senior secured position, you probably feel a lot better now than you did a couple of years ago. And ultimately what happened is as the market crashed from the debt side of the equation, if people had actually marked to market, you would have had a debt world that was completely upside down. Just imagine the financial wherewithal of a company that took $100 million of debt to drill a series of wells, that all of a sudden when oil went from 100 to 30, we're now losing $1 million a month. Well, at that point in time, what are you securitizing when it's losing $1 million a month? Not a whole lot, right? So your assets are worth -0. And that's kind of the worst case scenario, which is why you saw most companies that didn't have to not really mark those assets down to that level, because they were anticipating a recovery, and if they had the ability to not mark them down, they didn't. Well, at this point in time, that debt has really come on the other side, where most companies will probably be able to pay off their debt service. So it's probably been the best thing for them not to mark to market, right? Because ultimately, at this point where pricing is right now, the debtors will probably recover their investment. The equity side is a whole different game, because if you think about it, it depends on how heavily levered that company was. And if, as a going concern as a company, their next 5 years or 7 years of growth is going to be significantly retarded by doing nothing more than paying down that existing debt service, then you're going to have a situation where an equity holder, you may not have that recovery, even though there is a price recovery. So again, it's a unique part to say, where are we in the value chain as a historic investor, right? And where do you fall, and is the debt worth more than the equity? Is there upside in the sector going forward? I think the one thing that's fair to say, if you put that in juxtaposition to what I just mentioned, is when you look at a new entry or a way of investing in this space, it's probably a generational opportunity if you don't have a hangover from the past. So if you're starting a new co or a new fund or a new opportunity, whether it's private equity, whether it's a C Corp, whether it's debt, it's irrelevant, I think, the structure. Ultimately, if there's no baggage from the past, this is probably a phenomenal entry point with a whole lot of room to run. And yet, if you're looking at the same company that is an existing company, it might do well in the future, but its hangover from the past might be so bad that it weighs down that future growth. So it's a very unique world, that it is a very healthy industry and an amazing time to invest. You just have to somehow figure out, and I put one word to it, what is the legacy of the entity you're investing in? And if you can determine if that legacy is risky or not risky, then you can make a very intelligent decision going forward. So I think that there are just as many zombie companies out in the industry as there are healthy companies. The question is, how do you dissect those two things? So from an equity and a debt standpoint, that's kind of my general market overview. The really unique part is where will pricing go in the future, and how does that obviously affect the investments or the overall marketplace as the oil and gas industry. And to sum up everything that you hear in the market, because this could be a 4-hour dissertation on just pricing, I think ultimately what is coming to bear is there is a significant gap between demand and supply. So ultimately, if we don't face a significant recession or depressionary environment, which I think everyone is clear that we're not really facing in the near term, the gap is within 12 months where the demand side far exceeds supply. In fact, it currently already exceeds supply. And it's getting worse and worse and worse as we go. And for a host of reasons, we're not going to be able to catch up with that. What that means is upward pressure on price from an oil perspective. Now, there can be geopolitical events to the good and the bad that stall that or accelerate that, right? So sanctions on Iran accelerate that growth pace of price going higher than it should actually go in a short period of time. Releasing the strategic reserves can lower that, right? So it just depends on what geopolitical events happen in terms of the speed. But ultimately, we know there's a gap between demand and supply is not keeping up with demand. Now, why is that there, and is that something that people can fix? That is the ultimate question, right? Can and will the industry catch up with supply as demand continues to increase? And there is one area of the world that still has, theoretically, whether it's practical or not, about 1 million to 1.5 million barrels a day, and that's Saudi Arabia, that could increase supply to match that demand gap. People assume the U.S. can do the same. But the reality is what you've already started to see in the last 2 months is the U.S. has stalled out on its production growth. And in fact, the EIA, the Energy Information Administration, has, I think, prognosticated too aggressively that we would be able to keep up supply. And what you're seeing is that there's not enough infrastructure investment in this country to get supply to market. So even if we could drill it, it's not coming to market. And thus, if the U.S. can't fulfill that gap, because there's really only one area in today's pricing that it was coming from, which is the Permian, then ultimately you're going to have a situation where if Saudi Arabia does not fill that gap, prices are going to rise significantly from here. Now, our personal hope and bias is that it does not. Let me repeat that. Most people would think as an oil company, we want it to go up. The most successful investing environment for us, because we're more of an investment company than we are an oil company, oil and gas is what we do. Investing is how we think. The opportunities at 50, 60, 70, and 80 are significantly greater than the opportunities at 90, 100, and 110. And part of it is the margins are just as good now. They don't go up when prices go up. In fact, just your vendors take more. What goes up is your risk paradigm. So right now you have a low risk set and a great margin. It's kind of that opportune time to invest. If you get 90 and 100 and $110 oil, there's a lot of money floating around that invests very frivolously and thus raises all prices and makes the competitive environment tougher to find great opportunities. So ironically, we like where we are, and we hope a lot of geopolitical events occur to the positive to keep prices depressed. But if you were to flip a coin, it is probably a greater likelihood that you'll see $120 and $140 oil in the next 2 to 3 years than you will stay in the 70s and 80s. Now, that's a shame because I think all of us know how finance works. Once you get to that $100, $120, and especially the $140 oil, it starts affecting gasoline prices at the pump, which in fact affects sentiment, which all of a sudden will literally come back to that pendulum going back down to 40 again for oil. So 140 means 40. It's a bad thing, right? Whereas 80 and 90 can be sustained indefinitely, 140 cannot. So ironically, you would think we would want higher prices. We actually want stable prices, but it's probably a flip of the coin as to which way it goes. And I think currently it's probably a flip of the coin leaning towards the side of prices rising too fast. Again, if you're a short-term investor, that's fantastic, right? You buy now at a very low price, you make a ton of money on the way up, fantastic. We're a 40, 50-year investor. We like the long-term a lot better than the short-term, so we'd rather see a lot more consistency. And again, that's just from a macro of the market, our general overview of what could or could not happen and what we see likely. Obviously, throw in the caveat, you go into a global depression, which we don't see as likely, but the trade wars go off on a hinge and all of a sudden the economy tanks. you could see prices come back down to 50s again out of just supply demand, but I just don't think that's probably the most likely of realities. So again, what does that all mean? How does that affect our industry? What does that mean going forward? One of the things that's the most unique about our industry is that there's these long cycles, and opportunities do change through those market cycles. And as an example, people would think that when the market is at its bottom is the perfect time to invest as an oil and gas company. And usually it's pretty funny because in behavioral finance, investors tend to always invest when the market peaks, not when it valleys, right? It's just behavioral finance 101. We get interested right around the peak of the market, and then it inevitably crashes. Well, a lot of investors got excited afterwards and started thinking more like institutional investors, right? Let's invest at the bottom instead of the top. The irony is in some sectors of the market, the bottom also isn't the best time to invest. If you could remember earlier when I described, if you were losing $1 million a month in a field, is that a good time to invest in it? Well, if it's losing $1 million a month, that's not the best time, right? When it's actually making a little bit of money, but not yet at its peak, that's the more opportune time in our space. What does that equate to? $50 oil, $60 oil, $70 oil. Those are actually kind of your most consistent peak economic years where you have great margins and low costs. You start to get consistent $80, $90, $100 oil, you still might get good profits, but now your costs are coming up and your margins aren't necessarily increasing, but your risk profile is, right? So, and then what happens is there's different parts of the market that can become very timely. So, as an example, if I'm investing in traditional drilling, what I just described is very accurate. If I'm investing in midstream activities like pipelines, well, price is a little bit less concerning to me. I'm only concerned with how price affects volume, because what I care about is how much oil or gas is going through a pipeline. So a lot of that opportunity, if oil is 30 or 90, is a lot more based on the region. And if that region, so as an example, as we remember, even at 30, the Permian Basin in West Texas was going bananas. So if I was in the infrastructure business and I was investing in pipelines in the midstream, I was still making money at 30, probably a ton of money. Even when natural gas is $2 an MCF, there's still so much volume in the Marcellus and the Utica Shale that I'm at maximum capacity. So infrastructure can have a very different cycle than the actual downstream or upstream side of the activity, the drilling or the refining side of the business. And that's part that investors don't really think. They somehow assume that price is the overlying factor for all oil and gas investing, and it's not. It's for the E&P side, the exploration and production side, it's very true, but not for all the other sides of the oil and gas business. So again, kind of a unique scenario that I think people don't always think about. So again, what does that again mean to a actual investor? What I think is that investors, at least from our perspective, are starting to change their paradigm of thought of how they invest in oil and gas. So the traditional way that most investors have invested and all the capital raise in our space from this independent channel has gone towards these things called drilling funds, which are very tax heavy, right? They offer huge tax incentives and you drill a series of wells. And there are certain market conditions like right now that are optimal for those. So for a 2 to 3 year period of time, from probably last year to the next 2.5 years, there is going to be a heavy investment in that specific asset class within the energy sector because it is very timely. You couple that with all the tax law changes that just occurred, with all the SALT taxes and the losses of itemized deductions, and you're probably going to have even a greater investor behavior that wants to invest in those tax deals. So artificially, you're seeing, I think, a boon for the next 3 years in that part of the oil and gas sector. Probably one of the biggest capital raises in history will happen over the next 3 years in traditional drilling funds. But if we weren't in that market condition that we happen to be in right now, what is actually really starting to take shape underneath this is the underlying investments in the oil and gas space are changing dynamically. And if we weren't in this part of the cycle with the current tax law changes and it happens to be the optimal time to drill, I think a lot of other investors would be seeing the new style of investing that has occurred, which is much more holistic, not investing in just well bores, but investing in everything from the infrastructure to the land to the development. And a host of companies are going to design those funds very differently. Some will be more traditional private equity. Your 2 and 20 funds that buy an asset, develop it, and flip it, right? Some will be land banking style, where you buy an out of favor land, and as people drill it, it goes up in value and they flip it. Some of it will be very infrastructure sensitive, right? Just pure gas or oil pipelines and fractionation systems and saltwater disposal systems around the service side of the industry. And some of them will be much broader and agnostic and looking for all vertically integrated parts of the oil and gas space. And I think if we weren't in this part of the cycle, most investors would realize that the economic opportunities in those assets are far superior to just tax and drilling funds. But because of the current status of where we are, that may not be true for 3 years. So I think you're going to see this skew where the industry is really going. And I think in 5 years, what you're going to see is a bandwidth of funds that are much different than what people think about when they think of oil and gas. And you'll see these tax deals that are working, they'll be a smaller part of the pie. Instead of being 90% of sales, they'll be 9% of sales. And I think that's happening. And I think it would already be here based on where the market was going if it weren't for what happened with commodity prices. I think if we weren't in this part of the cycle, you would already be at the phase where 60 to 70% of sales and purchases of oil and gas direct securities would have been reshaped. The problem is the demand is now going to skew that for a little bit of time, where you're still going to see probably at least 50% being the traditional drilling funds, and the rest come down the pike. And I'll give you an example of that. I think there's a specific vertical in 1031 exchanges that are probably likely to explode for the next couple of years in oil and gas, because most people don't realize that oil and gas still under the tax law is still real property. So it is eligible for an exchange. And if you look at the market cycles between the two asset classes, you have real estate investors who feel a lot of compression with cap rates and feel that there's nowhere to go with their capital. And when they look at another sector like energy and they realize they can make a like-kind exchange into a similar investment vehicle, although it performs very differently and is not akin to real estate, it is real property. And so I think you're going to start to see 5, 10, 15% of a lot of 1031 exchanges go from real estate to oil and gas as a diversification tool during this part of the peak cycle of real estate. And I think that's going to probably open up that channel to a much larger demographic than oil and gas has historically seen. I think it's going to be a very large avenue for capital raise in this space. But here's the part that scares me the most, and I mentioned this at a lot of different organizations. Looking back over the last 5 years, the retail space from the independent investment advisor has really shrunk in terms of sales of oil and gas dynamically. So our company has taken up almost all of the space in terms of sales. 50, 60% of it has been with us, but most companies have been shrinking or going away. And the sad part about that is that's not the true with direct investments to retail investors. So on the opposite side of the equation, retail investors bought almost $14.5 billion of private placements around advisors last year. That means direct. So it's almost gone old school, where you have the old school oil and gas operators selling direct to clients, not through the investment community. And that's scary, because then there's no due diligence, there's no oversight. The products are really something that have no definitions on fees or fee compression. It's really the Wild West. And what's happened is instead of being offered through the BDs, clients are still buying it. They're just buying it direct to a sponsor. And that to me is an amazing phenomenon that I haven't seen in most market segments. So ultimately, if clients want it, it has to be there for them. But it should go through a securitized channel that actually eliminates the riffraff from the better funds. And actually, the irony is the opposite is happening, where clients are just going around investment advisors and buying it direct with companies. And as you and I probably know, not that there's anything wrong with it, but most of those are probably going to fail and fail significantly because they just don't have any checks or balances put into place. So my goal is hopefully to get that $14 to $15 billion a year back into the independent space instead of going around it direct to clients. And that is the ultimate goal, is to get those products on the shelf. And hopefully, I know I talk really fast, But hopefully that was a summation of our view of the energy industry, the products within them, and where we see the space going.